focus brought to you by IG, trying to digest the huge moves that we've been seeing in US dollar relative to the pound, relative to the euro. And this is, of course, in the aftermath of what might be deemed the most dovish Fed meeting in over 2 years. And thankfully, we have Paul Capetto with us to dissect the price action in these major forex pairs, Paul, and then we'll move on to the statement from Fed Chair Powell that sparked a lot of this, some of the biggest moves that we've seen all year over the course of the last 48 hours, and then get into some projections of where the market thinks and where the Fed thinks rates are going, because those are two very different things, but right now, one thing that the market is pricing in, and that's rate cuts and dollar downside. I mean, what's your initial take from the last 48 hours of price action, the Fed meeting that we digested? What to you is the biggest thing that we've seen come out of the last 48 hours?
Yeah, so it's been an action-packed 48 hours. Obviously, the Fed came out really dovish. Basically, rate hikes are on the table even sooner than we thought. Even March last week was kind of iffy on if we're going to have a rate cut, but now it looks to be well over 50% that we're going to get a rate cut in March. But then the BoE and ECB just followed up with a hawkish stance, so now we get this extended move for a weaker dollar. We saw pound get over 127 and euro get over 110. Euro's actually pulled back, and so has pound off its highs. Pound got very close to 128, but couldn't actually get past it.
And it feels like, of course, these are big moves for a short-term, chart. You're looking at the last 2 days. I mean, you look at those huge green bars the last 2 days, and you're like, wow, huge move. But it feels like, and I want to get your take on this. This feels like the most genuine of the last several times that the market and talking heads have tried to take down the dollar, essentially, because the dollar's on this historic run that we'll get to in a second. And amid this historic run, we've seen pound get up to 130. We've seen euro get up to 112 in the past. And we're not at those heights quite yet for those foreign currencies versus the dollar. But to your point, we have this stretch of within 24 hours, all these major central banks meeting. And this is one of the first times that the market is saying something, and the central banks are actually kind of saying the same thing, which is U.S. dovishness, more hawkishness abroad, and potentially rates kind of converging, and that translating to the price action that we're seeing here. I mean, is that what it feels like from where you're standing as well, that, this is the first time that people are talking about rate cuts in the U.S., but it really feels real at this point?
Yeah, we've been talking about rate cuts for a few months now, but now they seem to be more certainty around it that they actually are going to happen. Doesn't mean the Fed's not going to be data dependent. If the inflation data ticks a different way, we'll have a different conversation in a month or two. But again, it all depends. But how things are trending right now, they're trending towards rate cuts. The market is pricing in rate cuts. And just the velocity of these moves. I mean, when you see euro dollar basically move 200 points in 2 days, that's a large move, and it was 300 points in cable, which is pound dollar. So you just see basically the shifting tides in the market, and this is what can happen. Doesn't mean it can't pull back at any time either.
100%. Yeah, it must be reiterated that they did not cut rates.
Yeah,
Paul, they talked about cutting rates. But yeah, to your point, this has been priced in before. You go back to March, the regional bank crisis, and they absolutely slammed interest rate projections and thought that we were going to be cutting by now. And what happened is actually they went beyond 5% after that. We saw further interest rate highs after that point, and that's when you had the dollar fight all the way back against the euro down to 105 after all of that. And so, of course, these things change on a day-to-day basis. And when you saw euro, the last time we saw as violent of a move as we're seeing now, to the upside, was that trip from below 109 all the way up to above 112 in essentially a week or two, and it cracked back pretty quick. And so these things can change constantly, but you add in the historic context, and now looking at dollar versus yen because it's the greatest extreme. Obviously, it's relatively similar when you look at pound and euro, euro at 110, below its average price, closer to maybe 1.25, pound below 130, still far away from its more average price over the last 20 years, closer to 150. But you look at especially the dollar versus the yen here, Paul, and this is why it's been such a sexy bet over the course of the last 2 years, is because the dollar has appreciated so much over the course of the last 2 years that calling for the reversion to the mean that we've seen, so many times historically doesn't mean it has to happen, but it could mean that the dollar falls a lot further against the euro, pound, and yen if this interest rate projection comes to fruition of lower in the U.S. and potentially stagnant or even higher in places like Japan.
Yeah, and the BOJ is on tap for Monday night, and they have been finally hinting at rate hikes. So this is going to be a real interesting one to the start of next week. I believe we get some other data, but this one will be interesting. BOJ hasn't hiked rates in a very long time, and they've been always behind the curve on the rate hiking cycle, so they haven't even done anything yet.
I think it's since 2007 they haven't hiked rates.
Yeah, 16 years and a lot has happened in those 16 years. Yeah,
it's unbelievable, and so this is, like I say, it's an attractive thing for someone in the media to come out and say, we're going away from the dollar's going to dust, all these different things, because it seemed like something, as long as the historical mean reverting attributes that a lot of these forex markets tend to exhibit does stay the course in the future here, which is a big if. But if that is the case, obviously there's some great dollar depreciation to come at some point. Now, that's been the whole thing, because you know better than anyone that there's been plenty of money to be made longing the dollar over the course of the last couple of years, but also a lot of risk in shorting the dollar over the last couple of years if your timing is wrong. And the timing is the big piece of this, because again, all we got out of the Fed causing this dollar collapse that we've seen in the last 48 hours is words, is statements, is language as soft as here from Powell at the December FOMC. I would say there's a general expectation that rate cuts will be a topic for us looking ahead. So again, leaving himself as many outs as possible, but you see the correlating move here in 2 years, moving essentially from 475 down to 4.25. And though this seems like a soft dovish statement here, I mean, this is coming from a Fed Chair Powell who, Paul, has not even hinted at cuts for the last several years.
Yeah, no, it's definitely a little bit of a pivot from where their stance was previously. It's hard to make a lot out of these, because you just kind of look at what the market reaction is saying, and the market's taking it as that this is a dovish statement. Again, I'd always be cautious that, they always say they're data dependent. If the data changes, these statements, these words don't really mean anything in a couple months. So
we get 2 upticks in inflation.
Yeah.
And I think this is so different. Now, that being said, inflation has moved lower month over month, almost every month for the last 12. Yeah. And so feeling like it would take a lot. But I mean, the meeting that we're going to look at in a second is March. And that is essentially 3 data points away. And like you and I say, you get, 1, 2, even 3, obviously would be even more potentially hawkish upticks in inflation, outperforming numbers in employment. And you'll see those potential cuts get priced out pretty quickly. Now, here's the dot plot. And I want to take a look at what the Fed is saying, and especially with the particulars around where they see rates focused each year moving forward, because we're going to take a look at what the market thinks. And the Fed here, obviously everything focused around where rates currently are, which is 5.25%. They're done with the meetings this year in 2023. The focus for 2024 is around 4.5%. So, 75 basis points lower than where we currently are, with the longer term goal to get down to 2.5%, 3%. Now, you set this against the projections in the market, Paul, and they're going to look very different, especially as we move out to the end of the year. But I mean, even the fact that we're seeing an almost 20% chance of a cut at the next meeting is pretty wild compared to what we've seen over the course of the last couple of years. I mean, you've been monitoring these odds. Is a huge shift here to even say there's a 20%, an outside chance of a cut at the next meeting here.
Yeah, that's kind of, it's a little bit shocking that they're already thinking that there's a outside chance that it could happen in January. And I would think that the Fed's moving too quickly there, and they don't seem to want to move quickly. So that would be a bit of a surprise, but the market thinks, this is what the market thinks. This is what these kind of data points tell you, is that the market thinks there is a possibility out there, and it's not small. It's not the 5% chance that we kind of tend to ignore.
Yeah, and the closer that these probabilities get to, 20, 80, 30, 70, 50, 50, that tells you that the market is more spring loaded. And by the market, I mean interest rates, forex, stocks, everything, for a big reaction one way or the other, because they're essentially throwing their hands up saying, we don't actually know what's going to happen. Whereas the last 3 years of Fed activity, we've known with fair certainty going into it exactly what they're going to do. It's always 98%, 99% priced in. And this is the next meeting, and it doesn't seem like much, but it's 2080. And so if the Fed, let's say we get an inflation number that's actually in the 2 handle in January, and we get a non-farm in January that's under the expected amount of employment data, under expectations, let's say, and they do end up cutting 25 basis points in January, you're going to see huge reactions out of forex and everything else. But even if you see the antithesis of that, the opposite of everything I just said, 20% being priced out of the market is still worth a good shakeup across rates, forex, stocks, and everything else. Not to mention the expectations that are getting built in for the second meeting of next year. March has been everybody's eyes on the March Fed meeting, as we've gone back and forth between, okay, more than 50%, less than 50% chance of a rate cut in March. Paul, you've been watching these odds all week. Going into the meeting, less than a 50% chance of a rate cut in March. Now, today, 83% chance. Crazy move.
Yeah, absolutely crazy. I mean, there's a chance of 25 basis point cuts in the next 3 months, basically. I mean, this year's pretty much done with at this point, but that's a dramatic move and a dramatic shift, and that's why you get those resulting moves in the dollar, and they become extreme when the market's kind of repricing itself. And that's really what we've seen over the last 2 days. And this is an interesting one because, I mean, they didn't really tell us that they're going to cut rates. They just hinted at it. And this is kind of the market just saying that they're going to cut rates, or the market's believing that they're going to cut rates. Doesn't mean they have to. And again, like you said, if we see something change in inflation or employment, these odds can shift again by March.
Yeah, keep that in the back of your mind, that dot plot that we looked at, where they're only 75 basis points lower than the current rate by the end of 2024, because now you look at the December 2024 meeting, and Paul, there's a 74% chance of sub 4% interest rates by this meeting, which is to say, let me decipher just for a second. I know you would know what that means, but it's a lot to take in. We're at 5.25%. So the market thinking that the more than likely chance is that they cut by over 100 basis points by the end of next year. 74% chance. That's not even, it's 50-50. that's a resounding high likelihood, 74% chance of sub 4% interest rates. We're right now at 5.25%. The dot plot says 4.5%. And so either the Fed is wrong or the market is wrong. One thing for sure, there's going to be a lot of activity because, yeah, to your point, not only do these odds shift with interest rate markets, but you can assign, obviously with a certain amount of variance, that as more cuts get priced in, that's worth, 50, 60 pips in the US dollar to the downside. If these shift back in the other direction, theoretically, you would imagine that that's worth more dollar upside and regaining some lost ground that we've seen over the last 48 hours. But, what's your take on this market versus the Fed moving forward? Because, it's going to come up really quickly in that January and March meeting. If they cut, then in either of those meetings, this becomes more realistic and that dot plot becomes less realistic, and you might see some dollar downside very quickly. If they don't cut in those first two meetings, these odds shift closer to the dot plot. A lot at stake here between the Fed and the market.
Yeah, so pre-Fed, we were thinking 25 basis point cuts for next year. Now we're looking at 6 to 7. So you get 2 extra rate cuts and a 200 to 300 pip move in Eurodollar and cable. So obviously that's what the market has priced in there. It's really interesting that there were basically 100 basis points from the dot plot by the end of the year. That's there's some divergence there, and when that divergence comes together, it's when you get actually those market moves. So it'll be interesting to see. Again, this one's so far out, and it's so far to know where we're going to be in 12 months, especially as much as the economy's been changing with inflation. And I know we've talked about it many times, but the employment picture is always in the back of my mind, more constantly now than it has ever been. So that's what I'm looking at moving forward is if that data even changes, how these odds shift. Basically, it almost seems too far, but I'm not sure. If that's what the market thinks, that's what the market thinks, basically. So you just have to work with that.
Yeah, absolutely. And this stuff will, though this is super far away, and that's obviously why there's such a wide distribution of likelihoods by the end of next year. But it will get more and more refined every month that we get into 2024. And so we'll see these big moves across rates and dollar versus euro, pound, yen, and beyond every step of the way. But yeah, you can at this point chalk it up to a Fed versus the market. And I love, of course, goes with the caveat, total inexact science, but every 25 basis point cut that gets priced in or priced out has, we've seen in the last 24 hours, been worth around 100 or so pips in dollar one way or the other. And so every time these rate projections fluctuate, which they're going to, because there's no central answer that's been priced in, there's wide distributions. Every Fed meeting of 2024 going to see huge moves in that dollar. But Paul, thanks so much for coming on with us for today's Forex Focus.